Good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review. My name is Benjamin Gold, Head of Research and Investing Education here at SIAS. With me is our Senior Technical Analyst, Sunny So. So we're going to be going over some of the key things that happened last week, as well as what you might want to look out for this coming week. As usual, the disclaimer is that SIAS is a registered charity. We're not licensed by NASDAQ, so whatever that you do, or rather, don't take our whatever we say as a recommendation. Do see a licensed financial professional before taking any kind of action in the capital markets. Couple of announcements before we get started. The upcoming SIAS session for next month is actually the 16th of August. But for the one in July, it's actually this Wednesday evening. So please chope your seats if you have not already done so. This is via the QR code or the HTML over here. Do give us a 5-star Google review, and I'm being thick-skinned for asking you for it. This is really just to make sure that we, do have some feedback and to calibrate our programming, right? We do have the SIAS membership, so it's going for $12 a year, which is $1 a month. Yeah, $1 a month, that's correct. Which is less than a upsized Burger King meal, which is actually pretty expensive. Not to even talk about Shake Shack, which I drove by today. It's really expensive. But anyway. Okay, let's get to today's content. Now, as we spoke about last week, the S&P 500 earnings season had kicked off last week with the announcement by some of the big financials. We'll talk about it in a minute. Now, going into this current earnings season, the consensus estimate for both profit as well as revenue has been adjusted down. This is basically just to reflect the reality that margin compression is still ongoing and there are still challenges in the global economy as well as what's happening in the US specifically. So consensus estimate is to have a 9% profit drop for the second quarter earnings season, which is happening right now. This is the worst since the year 2020, which was really the COVID period. This really makes it easier for companies to beat the lower expectations. Now, if you think that a 9% profit drop for the second quarter is bad, well, the consensus estimate for the earnings season for Europe itself was really to expect a 12% profit drop for a second quarter. So you think this is bad? Well, other people have it worse. Okay, but the general idea is that the expectations have all been lowered already. So don't be surprised if some companies manage to jump that hurdle. But don't get too excited since it's already been managed down. Specifically for the 3 banks that reported last week, as you can see, all of them have got both upside surprise in terms of sales as well as profitability. Far and away, JP Morgan ran off with about a 24% earnings surprise. Now, this is always very classic, right? You can see that the sales surprise and earnings surprise is not, well, it's directionally the same, like both positive, but in terms of magnitude, it is not. Simply because sales, from an accounting perspective, it's very hard to create sales out of thin air unless the company is called Enron. That was old news. But earnings is a outcome of accounting treatment. So depending on how you want to set your accounting policies, things like depreciation, amortization, when you want to recognize profits, so on and so forth, there's some flexibility. So as you can see, right, the earnings is far and away multiples of the sales surprise. Now, the big narrative here is that for the big banks that benefited from 2 main themes. One is that you have got the implosion of the small to mid-tier banks in the US. So we're talking about the Silicon Valley Bank, the First Republic, so on and so forth. So that scare really moved a lot of the depositors' money from the small to mid-cap size or the small to mid-size banks to the big boys. So that's one. Having a larger depository base basically means that there's lower competition for deposits, which means that the big banks do not have to offer such a high interest rates to entice people to open a savings account with them. So it's like this, right? So if the cost of funding for a bank, in this case, basically the interest you need to pay your deposits is lower or not rising as fast, then you can actually charge people a high interest rate for home loans, car loans, so on and so forth, with the excuse that inflation is high, but actually your cost of funding is actually not going up as high as that. So which means that the net interest margin for the big banks are basically not too shabby, didn't lead to any kind of dramatic compression. That again explains why the earnings surprise was so significant, at least for the big banks. All right. Sunny will be talking about this in a little bit more in a minute. Okay, now we've spoken a lot about the tech rally since the beginning of the year, or at least since the end of the first quarter. This is basically a chart to kind of show the difference between the NASDAQ 100's PE ratio, as well as one of the, I guess, rising stars in the AI space, NVIDIA. As you can see, NVIDIA's PE ratio has kind of dropped quite a fair bit since the mid-May. And the concern here is that if, let's say, this were to continue dropping, let's say the second quarter results comes out, it's not so great, price drops, then obviously that's going to drag down the entire NASDAQ 100. Now, as a point of reference, the 20-year median, that means kind of the average of the NASDAQ 100's PE ratio stands about 18.6. Right, so currently the NASDAQ 100's PE ratio is close to 27, which is incredibly rich, very frothy compared to its 20-year median. Therefore, it is pretty vulnerable if, let's say, the profitability of the big 5 tech companies disappoints. All right, so something to look out for in the weeks ahead in this earnings season. Now, in general, wage inflation is still extremely sticky. We have got headline inflation, which has come off. So definitely it's come down quite far away from the double-digit inflation that the US once looked at many months ago. But it simply means that the increase in cost is slowing down, but it's not negative, right? And certainly, if you look at, if you unpack the headline numbers, if you look at the wage costs, hourly earnings have not gone down, actually. They've actually kind of been held stable, so on and so forth. So which means that labor cost is not really coming down. It still forms quite a big part of the cost base of companies out there, and therefore margin compression is still ongoing. So as you can see, the forward net margin for the S&P 500 on a consensus basis has come down quite a fair bit, while the stock prices are still going up, which is obviously, after a while, there's obviously a lagging effect here. But after a while, if the second quarter earnings as well as going forward future earnings do not pick up, then obviously the margin compression is going to drag down valuations. Now, the other thing I want to talk about is earnings downgrades, right? So we talked about wage-driven inflation being sticky. We talked about margin compression. Still a couple of risk factors out there bubbling under the surface, which is bankruptcies in the US are climbing up. Defaults in credit cards are climbing up, but not significantly so. As you can see that the long-awaited Armageddon in the credit space has not happened yet, and hence the big banks like JP Morgan are still humming along. All right, so that may or may not happen, but rest assured, just a side note, rest assured that the big banks have already put in sufficient reserves for that. But that still may be in the coming out in the next few months. So we don't know. But generally, the case is that we want to be paying quite a lot of attention to the forward guidance. So whenever a company reports its earnings, normally it will give some kind of outlook. The CEO will talk about outlook in the next quarter and next year, so on and so forth. We call it forward guidance. So there may or may not be any hard numbers, but basically the sentiment as well as what the CEO says is actually quite important, right? So that might be especially important in this current earnings season, given how rich valuations are right now. So even if the company does beat its consensus estimates, if the CEO says that the second half is not going to be as great as the first half or something to that effect, that might have a dampening effect on the stock price. So do look out for that. So forward guidance matters a little bit more than usual in this current cycle here. All right. Okay. So I am gonna We give the time over to Sunny.
Okay, thanks Benjamin for the nice illustration on the chart, as well as talking us through, giving us the explanations to look at the stock market as well as the economy from different angles. So I think I always appreciate Benjamin's sharing, so that to ensure that I have already checked all my blind spots and all my real view mirrors to make sure that the data that we cover or the data that we went through is actually sort of in line and talking sense to us. So my presentation today will maybe be a bit boring because I always look at the numbers that you guys know, but I'll try my best to explain them in detail. So last week, on 7th of July, Friday, that was the big headline news that we saw on the economic data front. We have the inflation rate numbers coming month on month for the month of June. The actual number was 0.2% compared to the previous month of May at 0.1%. But it was below the market consensus or what the analysts estimate at 0.3%. So this is a slightly good news. So that means that inflation is not as bad as what the market or the analysts estimate thinking. However, it is 0.1% higher than previous month. So it is a reminder that inflation risk is not over yet. However, it's not as bad as expected. On the inflation rate year-on-year numbers for month of June, it comes in at 3% compared to the previous month of 4%. So this is something to cheer about. That's why most of the US market actually went up quite a bit last Friday. I will touch on the charts later on. And this was also a 0.1% lower than the market consensus. So all in all, overall, the inflation headline numbers was actually a slightly positive news according to the markets. So if we break down the numbers in detail a little bit, we look at the core inflation data, which does not take into account the price movement of the food and petrol. So that is these are the two big volatile components in calculating the inflation rate. The core inflation rate, which excludes those for the month of June year-on-year, comes in at 4.8%, which is a significant drop of about 0.5% from the previous month reading, and also below the consensus reading of 5%. The core inflation month-on-month number for the month of June coming at 0.2%, which is half of the previous month number of 0.4%, and also below the consensus numbers as well. So if I look at the core inflation rate year-on-year for the month of June, I'm going to hover over the summary chart over here. You can see that core inflation rate, which is a key sort of an indicator that the Fed is always looking at to sort of adjust their rate hike or even their rate projection forward. You can see that the decline in core inflation is pretty significant since we see the high somewhere in the third quarter of 2022 last year. So I believe we are going to be closing in on the core inflation rate or the inflation rate number of 2% very soon. Okay, now we're at 3%. So we are going to close in on the Fed mandate of 2% inflation rate very soon towards the end of the year. And that could mean that if that is going to happen, then the Fed may not have as much reasons to raise the interest rate anymore going into the end of the year as well as next year. And that could be another leg up for the market as well. So this week, we have, last week we have the PPI data also and the Michigan consumer sentiment data. So these are the two other data which you can look at, but may not move much of the needle as well. Much of the movement was actually after the news of the 7th of July inflation rate data. So this week, we are expecting a slowdown in the reporting of the economic numbers. We have the retail sales number month of June coming in at consensus is predicting that it comes in at 0.5 versus previous month of 0.3. So we are expecting an improvement in the retail sales number. So another positive sign if we go in line with the consensus that economy is actually still doing quite okay. We also have a building permits taking a check on the property sector to see that actually they are still growing as well. So previous number at 1.496 this month consensus is expected at 1.5 million. So slightly above the previous month reading. So that means another positive reason to say that the economy is still on track for recovery, even though we have so much of a rate hike. For the past close to a year already, we have been seeing the rate hikes coming in pretty strong. So of course, on 27th of July, we have the Fed interest rate decision towards the end of July. And we are expecting another 25 basis point hike to bring the interest rate from 5.25 to 5.5%. So talking about this, we have no choice but to look at the CME Fed Watch tool to see the Fed fund pricing of what is the probability that we are going to see a 25 basis point hike. So the meeting date 26th of July, do to mark that date down in your calendar because that may have a very big impact on the market movement on that day itself, and you might want to be have your hands on the deck to watch the market to take on any opportunities or even sort of try to rebalance your portfolio a little bit. So probability that's coming in, the latest reading we have is about 96.1%. So this is, I would say, a probability reading that, or more or less, this 25 basis point has already been priced into the market already. So if let's say we have a 25 basis point hike, then definitely there should not be any of a big movement on the stock market itself or the major US indices. However, if we do not have a 25 basis point hike, and then we have a sort of a stance that is maintained at the 5.25%, then this would become another catalyst for the market to go higher, because some of the market talk saying that since the inflation numbers is already pretty nice and it's on track to come down, so the Fed may have a chance that they are not going to increase the 25 basis point hike this time around and do a wait and see approach. So if that happens, then definitely the market will go even higher. So after the CME Fed Watch 2, we will be looking at the earnings calendar. So Ben just now go over some of the charts of what is the expectation of the earnings seasons this time around. I'm going to put in some of the numbers. As you can see over here, traditionally we start off with the financial sector, the banks. So this actually tells us that you can see most of the banks, the major banks over here, JP Morgan, Wells Fargo, and even Citigroup came in with pretty positive numbers on the EPS as well as on the revenue side. So it's the earnings surprise and it's green color. So that means that economy, at least from what the corporates are telling us, the big banks are telling us for now, that it is still okay and pretty healthy. And this week, we are expecting Bank of America, Morgan Stanley, continuation of the big banks reporting. So that should be in line with what we see with JP Morgan and Wells Fargo, hopefully, and that would further rubber stamp that the economy is in a very good state. And even if we see another couple of small rate hikes, the economy should still be doing fine. Of course, after this, I think a lot of you will be interested in Tesla, very crowded kind of trading, a lot of interest. So this is the numbers to watch out for. Of course, for Tesla numbers, you can't compare it with the bank numbers. You'll be looking out for the delivery numbers, as well as the usual, the financial numbers that you'll be looking at, EPS and revenue. So do look out at that. Do look out for that 19th of July on Wednesday. And of course, after Tesla, you have most of the big tech coming in after the major banks reporting. You will be looking at Microsoft, Alphabet. These are the major tech stocks and how the AI sort of a business is maybe doing for the big companies, big tech stocks. So that's what Ben touched on earlier. So do save the date, 25th of July, Tuesday, big tech stock will start to give their earnings report. And this will likely be closely watched to see whether the tech rally or the AI rally for the recent few months is likely going to sustain going forward. On the Asia side, the Chinese side, today we have the industrial production number year on year for the month of June. So the numbers are not out yet, but if you want to keep a lookout for that, this would give us an update on how the health or the economic growth of China is doing. So we also have the GDP growth rate coming in year on year for Q2, previously at 4.5%. Now the consensus is 7.3%. So this is the numbers to watch out for and could move a little bit of the needle on the Asia indices side, especially on the STI as well. So these are the two numbers to watch out for in our time zone. So lastly, I'll go on to the technical chart. I'll just go through the index over here. If you want to go to, look at some of the counters of interest, you might want to look at the other video on the technical insights video, which I'll be sharing on some of the Singapore counters. Okay, so overall, the Dow Jones Index was up 113 points last Friday. Or in percentage term is 0.33%. As you can see over here, we have reached a resistance level, which is this red line. Previously, it was demarcated because of this high in May, the high in February, and as well as this high in the January period that we see this year. So this is actually a sort of a triple top kind of a formation, which is a strong resistance level. But as you can see, recently in the month of June and July, we have been breaching up above this level. And it seems that we are likely going to test the next resistance level, which is high in December. And that's around the 34,712 points. Upper bound of the Bollinger Band is at 34,754 points. So I think this is the next resistance level to watch and would likely cap the Dow Jones Index from advancing further. But the point to take note here is we have the bank earnings coming up, we have the big tech earnings coming up, which are huge components of the Dow Jones Index in terms of weightage. So that might push the Dow Jones Index higher, especially when you see the MACD indicator having a positive reading, as well as the RSI also having a pretty healthy reading at 60 points. So there is actually momentum in the Dow Jones Index to push the index points higher, or to push the candlestick higher on the chart. But I think the trajectory connecting the low of October as well as March of this year, this uptrend trajectory is likely to continue to stand. So if we were to breach the December high, then the next level to watch out for, I will zoom out a little bit. This will be the key level to watch, which is high in April last year at the level of 35,492 points, which is, I will just round it off at 35,500 points. That will be the next resistance to watch out for if we have a very strong earnings seasons coming in the next few weeks. Okay, so this is the Dow Jones Index. However, if you are looking to get back into the Dow Jones Index, you might want to be a bit prudent and you might want to look at the lower bound of the Bollinger Band, which is 33,469. We sort of may have coincided with the uptrend line that you see here. So around this level where you see the confluence of the uptrend line and the lower bound of the Bollinger Band, it would be a very strong or a good entry level to look at getting my Dow Jones Index in a very conservative and prudent term. So I will just draw a horizontal line over here, okay, which I have maybe see some inclination because this may be a mini double bottom formation and hence may also provide further support for the Dow Jones Index should a pullback happen. So this is a very strong kind of a support that I'll be looking at for the Dow Jones Index to get back in if I were to see a pullback towards the lower bound of the Bollinger Band at 33,400 or even at 33,500 level and play to the next resistance level of 35,500, which I shared earlier, which is the high of April last year. So the S&P 500 index is even more bullish. We used to have a mini double top formation, which is a resistance level. It has now broken through last week since we have the first week of the earnings season. And it seems that the data that we have so far from the corporate earnings is that the economy is still doing very well. Hence, this is a justification that the resistance level may have a change in polarity to become a support level going forward. So if this becomes a support level, for the 4,448 level is going to become a support level because S&P 500 actually closed above the 4,500 points last week. So this means that the next resistance level that we'll be looking at will be the March high that we see last year, and that's around the 4,637 point level, much higher than the upper bound of the Bollinger Band at 4,533. So in a very strong uptrend market, it's not surprising to see that the candlestick actually trend on the top side of the upper bound of the Bollinger Band to push the market higher. On the indicator side, we can see MACD histogram is positive, MACD reading is positive, so there might still be positive momentum in the index point itself. The RSI index is reading at 69.7. It has sort of a not technically has not breached the 70-point overbought mark yet, so has not sort of triggered the overbought signal yet. However, I would like to take note that on somewhere on the 16th or 15th of June, the highest RSI reading that we see is 76.36. So I will also take some notes over here. The index could actually push higher with even RSI above 70. However, once the RSI hit the 76-point reading that we see in 15th of June, on the RSI itself, it may form a double top formation as well, and that would be something that I'm thinking that I may take some money off the table, at least for the S&P 500, and that is the target that I'm looking at for the March high that I shared over here, the 4,637 points level. I hope market will push that higher along with the corporate earnings that will be coming out. And then the RSI should be around the 76-point level for a pullback to happen using this double top formation with a change in polarity as a support going forward. So you can see the 20 days moving average on the S&P 500 is also providing a very good support for the index as well. On two occasions, 26 June as well as 11 of July, we can see that the 20 days MA provided support to push the index higher as well. So that is another level that you want to look at, the Bollinger Band 20 days the Bollinger Band basis, which is the 20 days moving average, looking at 4,415 points. So that is another level you should consider getting back into the S&P 500 index. Next, let's move to the NASDAQ Composite Index, which has a similar kind of a chart pattern of formation, similar to the S&P 500. So we breached above the mini double top resistance level, and then this could become a support level going forward. So just reiterating what I say for the S&P 500 earlier. The next resistance level you can see over here is the March high of last year, and that is the 14,646 point level. So if the index, if the big tech earnings were to come out pretty positive, then this could be the next resistance level that push the index up another 500 points from the last Friday close of 14,113 points. MACD indicator still positive. The RSI level breached above 70, so it is in the overbought territory now. So overbought signal is triggered. However, you can see here on 15th on June, the high we saw is about 78 points. So we might need to recalibrate the RSI indicator setting to set it to the region of, let's see, the closer to the 78 points level. So you can actually set your upper bound and lower bound of the RSI indicator, okay, to about 75 or 78, so that it gives you a more of an accurate signal of to see where the pullback or where the overbought signal should actually be. But taking reference from 15th of June, this will be around the 78 points level. And that would be the first sign, I believe, we could see in the NASDAQ Composite Index of a pullback for traders to get back in who have not get on the uptrend yet. So this support level, 13,800 with a RSI reading above 78 points could be a pullback for traders to get back in at this level, 13,864. Next, let's move to the Asia side. So Asia Hong Seng Index, we have covered that quite a bit on all of our weekly market review. We said that in March, I believe this was the low, and after we have a lower low. However, this consolidation period since in March of this year to what we see now in July has been sort of a range bound kind of formation. And then although we have a lower low than the March low, which is a new year-to-date low, we can see that the recent formation for the Hang Seng Index now using the low in May as well as the low in July sort of form a double bottom formation. So this is a positive sign that a rebound, this rebound that we see in the past few days or last 1 week could be one that can be sustainable, because a double bottom formation is actually a pretty convincing and strong kind of a bottom that we see on the Hang Seng Index right now. So where is the target of the resistance level for the Hang Seng Index? Definitely the next level will be the 19,900 or the 20,000. This is sort of a psychological level. So 20,000 round number might be a resistance level to watch out for, which is also this point over here that you saw in 16th of June, the resistance level that we see here when the index consolidates back down again to the support level. So the next resistance level, upper bound of Bollinger Band, 20,199 or 20,200 with the high on 17th of April as the 20,800 points. I would think that is the near-term resistance that we should be looking at for the Hang Seng Index if we have a positive kind of news coming in from the Chinese side, whether the regulators have ended their tax scrutiny or their tax crackdown. We have seen that China has actually been inviting foreign tech companies or foreign big firms to come in for the negotiation for business, so that we could see as also a sort of like stimulus or trying to push the economy higher for the China side of things. So Hang Seng Index, I remain support level at this green line. March of this year, the 18,800 points, as well as the double bottom that you see over here, which is the 18,200 points, as a good support for the Hang Seng Index to get back in. So now that it has break above the 20-day moving average, which is the basis of the Bollinger Band, this is another sign that hopefully the 20-day moving average tries to turn higher and it will provide further support for the Hang Seng Index upwards. So MACD indicator, I'm looking at a pretty comforting or very encouraging kind of signal, because last week we actually had the MACD line cross above the signal line for the first time in about 2 weeks time, and then we have the first MACD histogram coming up. So the MACD histogram is now above the zero baseline reading at 44.41, so that is a positive indication. With the crossing of the MACD line above the signal line, that means that it confirms the change in direction of the Hang Seng Index since the beginning of the year, where it's a downtrend, and this could mean that we will be going into a new trend of an uptrend going forward for the MACD according to the MACD indicator. Especially if both the MACD line and the signal line cross above the zero baseline, the uptrend momentum will accelerate if that happens. The RSI is above 50-point neutral mark, the current reading at 55 points, so it's a healthy reading. We have a bit of a strength in the momentum for the past few trading days. So the RSI is a positive signal, and we still have some gap between the 70-point mark, which is the overbought signal. So that means that the momentum that we see right now in the Hang Seng Index can still grow quite a bit before we hit the overbought signal. So that means all is looking good for the Hang Seng Index, and I think this rebound is likely going to sustain to at least retest the April high that we see over here at 20,800 points. Next, let's move back to Singapore. So Singapore, last week we say that this is the low that happened, and then we say that it might have retest the low in March this year, and hence sort of negate the uptrend line that we see over here, this green line over here. And market since last week, based on the positive US data, has actually rallied up quite a bit, but then between these, there's quite a few gaps. So I'm very cautious of the STI index, and now that it has reached the resistance level, which is downtrend line, connecting the January, the April, as well as the June high, this downtrend line in red, you can see that today the STI index is down 18 points or about 0.5%, and this is the reason why it has hit the resistance level or the downtrend resistance level here. So where is the STI index likely to hit? I believe a pullback is likely going to be healthy. The 20 days moving average, the Bollinger Band basis, is likely going to provide some kind of a support, as you can see from this candle on 13th of July. And this could mean that if market is undecided, we can go into a converging triangle kind of formation, which means it can either break up or break down either way. But looking at the MACD indicator, a positive reading says that the breakout above is slightly more positive, and the RSI indicator at 57, still above the 50-point neutral mark, also says that it has healthy momentum. I will likely not bet against the STI index for now, but I think for now the direction is still not very clear whether it will go up or down. Much depend on where the North Asia market, the China market, or the US market will be leading us. So I think for now, it will be going to consolidation phase for this week to see how the earnings seasons play out before we have any clear direction on the STI index. So that is all I'll be sharing this week. Benjamin, anything else to add on?
No, thank you very much for that. Thank you very much for that. So as usual, illuminating technical analysis here. Obviously, the support and resistance that you give will be very helpful if, let's say, there's volatility in the next 2 weeks because of the earnings season. All right, so that's it for this week, folks. So have a great week ahead.